Good morning back in the US. I'm actually dialing at this time directly from Italy, where I'm reading the newspaper about all these beautiful situations happening around the world. So I'd like to give you a little bit of insight of the way we're looking at things today, and hope that all of this helps you, make better decisions, informed decisions based on everything that's going on. You know, so first of all, thank you if you're dialed in. If not, you're gonna be able to see this later on. You know, we what we think in this group, Soriano group, is that is important is to understand the baseline narratives in any given year. But that is imperative to assess what type of business cycle is developing, what is priced into the capital market, and how capital will move across asset classes as the cycle develops. That said, we are expecting this next business cycle to combine areas of expansion and contraction and workouts that create one that reminds us exactly what was happening during the 1990s. We believe the economic and investment narratives are beginning to transition into what we were expecting in a relatively transparent manner. The key is the degree of certainty in what drives liquidity and how that ultimately filters into the level of growth that you want. This does not mean that the path is going to be easy. Some of the excess cash on the sidelines has found its way back into the stocks and the bonds, and we don't see the story changing much overall for this particular year. But this enthusiasm that we've seen in the market would likely come with checks and balances, and that's what we call the banking sector the wild cards. The top two wild cards continue to be geopolitical risk, including in the United States, as elections are coming and they're around the block, and concerns about over commercial real estate exposure. Now, as new information is factored into the markets, we expect three potential periods of overall weakness: the February, mid-year, and traditional weaker September, October timeframes that could provide attractive buying opportunities in the equity markets and repositioning opportunities in the bonds. We'll be giving you most likely at the beginning of the second quarter another overview viewpoint in which I'm going to discuss the latest tactical and sector adjustments in portfolio management. These are designed to increase our or your exposure in the coming years to areas that are more correlated with easier financial conditions and typically are secular lows versus large capitalization shares in the US. And this is not perhaps due to the change of our positive view on higher quality bonds, but we do maintain a positive view on both stocks and both bonds overall. So I encourage you to connect with us again. Hit me up if you're connected. I'll be happy to answer questions. If not, I'll see you till next time.